Great. I will go ahead and start. Now, guys, I'm going to move over my control panel and I'm going to then go full screen again. There we go. So
Okay.
thanks for having me. Sorry for the technical difficulties. This is Company Valuations and Private Equity Basics. My name's Ken Boyd. I'll explain who I am in just a minute. So I'd like to start off with a question. Who is Philip Anschutz? Have you heard that name before? Well, if you haven't, Philip Anschutz happens to be, as of a few years ago, the 38th richest person in the US with an estimated net worth of over $12 billion, according to Forbes. He invested in stocks, real estate, and railroads. At one point, he owned the LA Lakers, the LA Kings, and the Staples Center, where those teams play. Grew up in Kansas, lives in Colorado, and a very reclusive guy that you very rarely see or hear about. But my favorite story in business and investing has to do with Philip Anschutz, and I think it's a great one to open this presentation. So it's the late 1960s, and Anschutz has a close to career-ending catastrophe, and how he reacts to this says everything about being a successful business person and investor. So to set the stage, he's got oil wells in Wyoming. And his oil rig supervisor calls him and he says, one of his wells has caught on fire. And if it's not capped and put out, all the oil that's coming out of the ground is burning off into the sky and he'll soon go broke. And Anschutz is quoted in the New York Times and says, there's a point that if you go forward, you win. Sometimes you win it all. And if you go back, you lose everything, which I think is a concept that really relates to investing and risk. So he did two pretty amazing things, I think. First, the fire signaled to him that there was more oil in the area, so he immediately bought up the land around it, a gutsy hunch that was rewarded richly because it did contain oil. And secondly, Red Adair was the famous firefighter, and he hired him to put out the blaze, and they used the footage from putting out the blaze in a John Wayne film, The Hellfighter. So if you ever see that film, you can pull up a snippet of it on YouTube. The oil well fires in the background and the scenes are actually real fires from Philip Anschutz's oil well. So why do I tell this story in an investing seminar? Well, I think it has everything to do with adaptation and change. And as technology changes, you as investors are required to read more, digest more, make decisions faster. Everything goes faster, and adaptation and change is tremendously important. So I use that as an introduction. And now for the purpose of this talk, there's a phrase that I love, I don't know where I found it, called moving the cookies to a lower shelf. That's really what the purpose is of this presentation. And what that means is making concepts more accessible to you as investors. And I've given this presentation to various groups, and there's really three different audiences. More than one of these may apply to you. This applies to entrepreneurs who are starting or considering starting businesses, to business owners who are growing a business and thinking about selling it. When should I sell it? For how much? How does the process work? And this has to do with investing as well, because you invest in companies that are bought, sold, go through mergers, buy product lines, divest product lines all the time. And finally, the third bullet point for potential buyers of businesses and for investors. So this content applies to all of those groups. So a quick word about who I am. My name's Ken Boyd. A friend of mine describes me as a professional explainer, and you can find everything about me at accountingaccidentally.com. I actually have over 200 blog posts there and links to 400 YouTube videos on accounting and finance. You'll see that I'm the author of 4 Dummies books, the first one being Cost Accounting for Dummies. I'm a contributing writer and spent about half my time writing for QuickBooks. If you saw Danny DeVito in the QuickBooks commercials this tax season, that's who I write for. If you go to QuickBooks and click on resources, I write about 7 articles a month for QuickBooks. I write for Investopedia and others. So I spend most of my time writing, but I have also done video on LinkedIn Learning, the former lynda.com, Creative Live, O'Reilly Media. And so the ground rules are, none of this is a deep dive into anything. I don't go deep into tax or legal issues, and there's always somebody on the call who knows more about a certain subject than I do. So I always lay that out as something at the beginning here. So I want to start off talking about what makes a company valuable. This is what you guys do as investors all day long. Generically, we're going to go generic then specific. So generically, brand awareness. Apple has amazing brand awareness. They have a massive cash balance, a lot of which for years has been stored overseas for tax reasons. Brand awareness, Apple's the best example. Stable customer base. I don't know about you, but where I live, we have 2 family-owned grocery stores that were founded 70, 80 years ago, and they get all of the grocery business where I am in St. Louis. You go to the same grocery store, you know how the aisles are laid out, and you do your thing all the time. Repeat business. How often do you go to a different grocery store? Probably not very often. Even though the margins in a grocery store are only 1% to 2%, they're profitable and extremely profitable in some cases because of the repeat business. A recipe, a secret sauce, is a third reason why businesses are valuable. I use the example of James Patterson, who writes the thriller novels. James Patterson actually has a team of people who write his books now because he has so nailed down and dialed in a specific recipe for writing thriller books that people are interested in that he can have a team of people write for him. So you are looking for, as investors, companies with a secret sauce. Walmart's secret sauce is we offer everything, low prices, and we've got a location within 10 miles of just about everybody in the US. That's their secret sauce. Willing to pay for convenience. With technology, better technology comes convenience. I love Spotify. I listen to Spotify while I work all day and write. Love Netflix. Why? For convenience. We don't go to Blockbuster anymore because Netflix streaming is far more convenient. So you're buying stocks that are valuable because of convenience. And finally, disruptors. We had the Uber and Lyft initial public offerings and that controversy in the last week or two. Disruptors gain market share now to make profits later. So those are some reasons why companies are valuable. Now, to go a little deeper, what you're really looking for as an investor long term is the ability to generate sales and profits, because most companies' valuations are based on sales, profits, or cash flow, or a combination of those things we'll see later. And I like to use a Play-Doh machine analogy to explain the fact that what you're really looking for as investors is a cash flow machine. You're looking for a business that can pump out cash flow. That has more value than anything else. So if you ever had a Play-Doh machine as a kid, you put the Play-Doh into the machine. And in business, the Play-Doh going into the machine is assets, cash, equipment, other assets that you put into the business. That's Play-Doh into the machine. You turn the crank in your Play-Doh machine. That is operations, making a product, selling, operations, logistics, shipping, supply chain, all of that is operations. And what comes out of the Play-Doh machine is a Play-Doh in a certain shape. What comes out of your business is a product or a service that generates cash. So we're really, as investors, looking for cash generation machines. Again, Apple being a great example of pumping out tremendous amounts of cash. Now, on the right-hand side, you'll see probably the most popular metric for measuring company valuation, EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. I'm going to skip, in the interest of time, the depletion explanation. So if you look at how much a company earns, and then we add back the expense of interest, tax expense and depreciation and amortization, that amount is what we use to value businesses. However, I think there's a weakness in the formula of EBITDA. And I'll use a pizza shop as an example. The problem with EBITDA is it doesn't take into account the cost of repairing, maintaining, and upgrading existing assets. So if you own a pizza shop and you've got ovens, refrigerators, furniture, and fixtures, that stuff will need to be replaced over time. And EBITDA does not take that into account because it removes depreciation expense as a factor. If you were going to buy a pizza shop and you looked at the balance sheet and you noticed that all the fixed assets, the ovens and the refrigerators, were all really old, you'd say to yourself, well, I have to replace those assets soon and I would pay less for that company. So capital expenditures, or as investors, you'll see the term CapEx, and I say grown-up companies plan for CapEx, meaning that you've got a budget for it, you got to figure out how to pay for those assets when you buy them, and that is not included in the EBITDA formula. So as a result, cash flow is really king. And I use the example of a plumbing company I dealt with many years ago as a CPA that did $3 million in annual sales. Now you would think that if you did residential plumbing, people would be falling out of the woodwork to get plumbing done, because when you have a plumbing problem, it's urgent. You need somebody right away and you're willing to pay whatever it takes to get a plumber, and that's generally true. However, this plumber had a problem. Go back, stay on the same slide. And the problem was that he took some of his cash and he invested in a commercial plumbing project, a new area for his business. He was a residential plumber doing homes, and he invested in a commercial project, which was an apartment building, and he lost a bunch of cash. As a result, he was running a profitable company that was chronically short of cash. Companies that are short of cash are handcuffed. They don't have flexibility. They spend a lot of time worrying and thinking about how to go out and get more cash. Those of you who invest in startup companies see burn rate all the time. What's the burn rate on Uber and Lyft as they use up cash to try to become profitable? It is a huge factor in investing. Now, this set of slides is a popular set of metrics for those of you who invest in tech companies, particularly fintech companies. So going through these, consumer acquisition cost. What's the cost of convincing a customer to buy a product or service? So if you run a tree service company that takes out stumps and cuts down trees, somebody finds you online, they call your business. Back in the day, they used to put ads in yellow pages. That was the biggest cost. So what does it cost you to find a client? What does it cost Netflix to get somebody to sign up for the service? That's customer acquisition cost. Monthly recurring revenue, MRR, income that a company can reliably anticipate every 30 days. Facebook and Google ad spending are great examples because people consistently go back and spend money on ads with these two platforms because they have the lion's share, something like over 85%, last I saw, of all advertising is Google and Facebook ads. It's reliable recurring revenue, very valuable. So the name of the game is keeping the customers that you have and limiting turnover and the cost to replace customers. This goes back to why grocery stores can be hugely successful. It's the repeat business. The question for Uber and Lyft is, do people keep coming back to those services? I generally do. My wife and I use Uber and probably will continue to. And then churn rate, the percentage of subscribers to a service that discontinue their subscription. And ESPN is the classic example of this. ESPN used to be get the biggest chunk of your cable bill. When you paid your cable bill for 500 channels, the biggest chunk of that went to ESPN for quite a while. But people are cutting the cord. They don't have cable anymore. I'm thinking of dumping it myself or going to a network that's far cheaper with fewer options. You see Sling and other options out there. What's the churn rate? What's the churn rate? So these are three great metrics if you're an investor in tech companies in particular. So now that we've talked about value, what are the strategies to enhance value? And this has everything to do, if you're an investor, with a strong management team. What you're really buying as an investor is not only a string of profits and earnings, but you're really buying a strong management team. Critically important. So how do people do it? Well, you can add to existing product lines. Procter & Gamble has done this successfully for decades. They add a new line of Tide soap. They add a new type of Doritos potato chips. People already buy Tide soap and Doritos, and they just add a product line because they have great brand awareness and customer loyalty. A unique product or service. If anybody in the audience is an attorney or knows attorneys, you know that intellectual property attorneys are some of the most highly compensated attorneys in the world because getting a patent, defending it legally has tremendous value. So if you can patent a unique system, product, or service, the Kentucky Fried Chicken secret sauce, that has tremendous value. Training is big and it's often neglected. We had the issue at Starbucks where they had an issue with handling a human resource problem, and Howard Schultz shut down all the stores nationally in the US and retrained everybody. It was a huge crisis. Training is often neglected. And finally, as I mentioned in the opening, investments in technology. Everything goes faster now. I have the husband of my niece works for Pinterest, and he is the guy, when you first go into Pinterest and you go on the homepage, he's the guy that maintains those home pages. How fast do they load? How do the graphics look? How easy is it to navigate? A company like Pinterest makes a massive investment in technology and upping the ante on that technology all the time. He was actually in New York when Pinterest went public. I'm going to shift and talk about some accounting things that also enhance company value. And these reasons are really why smart companies, well-managed companies, have to take the budgeting process seriously every year. You have to plan. You'd be surprised the number of large companies that you may invest in, that do not complete an annual budget before the start of the new year. You'd be surprised. I've worked at large companies that do not do that. They're still trying to budget in January and February the following year. It's a big issue. Pricing and cost allocation, cost volume profit analysis, where you can do sort of a what if analysis on sales prices, fixed costs, variable costs. Under and over costing. I wrote the book Cost Accounting for Dummies, and a basic premise of cost accounting is you have to recover all the cost of doing business by selling something. So when Uber and Lyft sell a ride to somebody, that cost has to cover the cost they pay the driver, the marketing costs, the tech costs, has to cover everything. And there's a big problem in business of what we call undercosting or overcosting. I'm going to skip the catering example in the interest of time. You have to assign costs properly to the product or services you're making, because if you do it wrong, you don't really know how much it costs to produce your product or service. It is a massive issue, a huge issue. I teach this all the time in my training. Sales mix. We all go to Home Depot or Lowe's, I would imagine. I happen to go to Home Depot. Let's say Home Depot sells a $200 lawnmower and a $5 hammer. Well, in terms of profit margin, net income divided by sales, the dollar, how much do you make on every dollar you sell? It may be more profitable to sell a hammer and earn 15% profit margin than to sell a $200 lawnmower and make a 10% profit margin. So Home Depot has a big focus on the mix of the products that they sell. What percentage of our total sales is lawnmowers versus hammers? Big box stores, Home Depot, Lowe's, Walmart, think about this all the time because you need to mix products and promote more profitable products so that the overall profit of your business is higher. A lot of you invest in companies that have hundreds of products, Home Depot, thousands of products. Sales mix is a huge issue. And by the way, you can read the management and discussion analysis in the annual report and find out a lot about how companies are changing their sales mix. Finally, closing an unprofitable division. You guys read about this in the media all the time. Sometimes it's just not profitable to keep a certain product line going. However, it's important to understand that the fixed costs often remain. If you have retail stores, for example, we see retail, brick and mortar retail having big declines. The problem is that those retailers have long-term leases on their space, and those fixed costs remain even if they shut down the store location. So many of those companies continue to operate because they want to cover the cost of the lease, even if they operate at a slight loss. So fixed costs remain if you shut down an unprofitable division. Reasons to consider a sale. So if you're an investor and senior management is considering a sale of a business, or if you invest in a company that is thinking of buying another business, why is the seller willing to sell? Number one, they're in a mature industry where a competitor can buy them and they can have economies of scale. I use the example of the camera business. We had a huge disruption when the iPhone came out and the ability to take pictures got better. And companies like Kodak and companies in the camera business tried to consolidate. Their market share was going away. Their technology was no longer attractive. So it may be that you're in a mature business by definition where sales are flat or declining. That might be a reason to sell. The age and outlook of your management team, because again, when you're an investor, the real secret sauce of your business is the experience of your management team and their ability to make smart decisions that make the company valuable, increase sales and profits. This is why it's so important for you as investors to pay attention to analyst reports, particularly when a member of senior management leaves. That can be devastating. Top right, reason to consider a sale, you need capital to grow, and if you don't have the capital, you sell. Years ago in the mid-90s, I worked for Boatman's Bank that was bought by Nations Bank in Charlotte, which is now Bank America. And the number one reason that Boatman's Bank sold to Nations was they knew they either had to sell the business or spend a massive amount on computer technology to grow as a bank. And they said, it's better for our shareholders if we sell. So you need you've got a decision to make. You're at a crossroads when it comes to raising money. Do we spend a whole ton of money or do we sell ourselves to somebody who already has what we need? Nations Bank already had the technology that they needed. And as complicated as all this is, when you boil it all down, there are really two ways to raise money to run your business: equity, finding investors, shareholders, and debt, finding creditors. And in fact, when you look at the balance sheet, there are two people that have a claim on assets: creditors, the liability section of your balance sheet, and investors, the equity section of your balance sheet. So you can tie the two ways you raise money to run your business to the balance sheet. Now the problem, and we saw this with Uber and Lyft, is that there are stakeholders. There are people that have a stake in the business when you decide to sell. Not only owners, shareholders, private shareholders in the case of Uber and Lyft, private investors. The company might have an employee stock ownership plan. Maybe management wants to buy the business using the value of an employee stock ownership plan. Customers and vendors are often neglected when you think about stakeholders in your business. customers and investors. If you think about Home Depot, Toro, who makes lawnmowers, is an important stakeholder because Toro supplies lawnmowers to Home Depot. And if a company's sales screws up to that relationship, that can really harm Home Depot as a business. And lenders, which is obvious. I'm going to skip through some of this stuff since we got a late start. I will mention on this slide, when there's a team of people to complete a sale, I want to mention investment banker, which is in the top right. The investment banker's responsibility is really to come up with a reasonable price to sell the business using traditional valuation methods like the ratios that we saw, EBITDA, the current state of the economy. You'll always see initial public offerings pick up in a good economy and slow down in a bad economy. After the 2008 crash, very little IPO business, for example. So the investment banker is the one person on this slide who has a tremendous impact. I know with Uber that a lot of people, I don't have it in front of me, but I believe Morgan Stanley was the lead underwriter, and a lot of people think they may have mispriced Uber. So I saw a headline that linked to the journal that people are frustrated with them as the lead banker. Finding a business sale, I'm going to skip through this because I want to get to some other stuff. And I want to talk about private equity. This is becoming a bigger and bigger issue for investors because private equity funds are getting bigger all the time. Private equity funds are getting involved in the public markets. If you read Forbes, there was a recent article about one of the big VC companies in Silicon Valley setting up a fund and getting registered to buy public companies. It's a bigger and bigger factor. So I really wanted to hit this. Private equity defined. These are investors that invest directly into private companies. They're private. In other words, they're not raising money from the general public. These are larger, wealthier, sophisticated investors. Now, here's what's weird and different about private equity as opposed to buying shares on an exchange. This is a long-term investment. And in fact, private equity investors sign paperwork understanding that they've got to leave business and money in the business for up to 10 years, because the idea is to spend 3 to 5 years growing the business and earning back your investment, and then spending another 3 to 5 years earning a return. So I have a friend of mine who does private equity, and when he left his private equity firm and went on his own, he said, I'll make more money in the next 3 years than I did in the past 3 years, because all these funds will pay out and earn profits that I've invested personally. So it is a long-term proposition. It is not a short-term deal. And the idea is to make improvements to the business to increase value. In many cases, private equity investors take an active role in management. They have seats on the board, and they have very high expectations. They put pressure on management. You see this in the financial media all the time. And there's a due diligence process that I'm going to skip over for the purposes of this presentation. Issues that can derail a purchase. So what happens when you're an investor and a company you own as an investor is trying to buy another firm and the whole thing falls apart? Why does that happen? Well, if you're a small business, a personal issue like an owner divorce can be a huge issue. Summer Redstone, the big technology and broadcasting investor, when he was a very, very old guy, there was problems with getting his company sold because he had gone through a divorce. And we see this with large businesses and small, that a personal issue like a divorce can hold up a business sale. Top right, no buy-seller agreement between the owners, the who gets what formula. So if owners are going to sell a business, who owns the most equity, who continues to get income payments, those are big, big issues that can hold up a sale. And poor credit meaning that the buyer does not have the financing resources to buy a business. And for Teddy's benefit, I'm going to do a few more slides here and wrap up. Real quickly on due diligence. Due diligence is essentially like an audit, a financial audit, except supplying a lot more information. So if you own a stock of a company that's in the process of being sold or buying another company, due diligence is what's going on, which is signing a letter, a non-disclosure agreement, and allowing the buyer to go through lots of records for the seller. For example, they want to look at not just financials, they want to know about contracts they have, employee agreements, vendor agreements, vendors who supply products. I'll use Toro as a supplier for Home Depot. What type of written agreement do they have? Because contracts have to be rewritten if there's a sale. So there's a way of planning for that if you're a seller by having written procedures, manuals, and other controls. A couple more points I wanted to cover before I wrap up. Business value, fair market value. What does the word value mean in this context? Fair market value is the price a willing buyer is willing to pay a seller, assuming that neither one is under pressure to do a transaction. That's a fair market value, like the fair market of a car or a house or whatever. But there are, and many of you see this as investors, there is an interest or a strategic value to buy a company. There is synergy. If Home Depot were to buy Lowe's, there's synergy there. There's economies of scale. We can take a lot of duplicated costs and get rid of them. We can advertise nationally together. We can put leverage on our vendors because we're buying Toro lawnmowers as two combined companies rather than one. Many of you buy companies because of interest or synergy. Liquidation value, I'll skip for now. I'm going to blow through consolidations and do one more slide, and then I'm going to wrap up. When you see company valuations, they can be based on several different measurements. The first that I mentioned early in the presentation, an income approach, which is how much income do you produce, how much cash flow do you produce, and it's typically a multiple of earnings or cash flow. There is an asset approach based on the current value of assets, particularly if you have some intellectual property, a patent, a copyright that is very valuable. People may be wanting to pay more for the assets. Good example is years ago when Michael Jackson bought the portfolio of Beatles songs and the royalties that those songs generated. And finally, a market approach, which is based on other measurements that financial analysts come up with. So in the interest of time, what I'd like to do, I'm going to skip to my last slide. It happens to be the next one. My email is there, ken@stltest.net. The place where you can find everything that I do is Accounting Accidentally, as I mentioned, which is on the screen. I've got 200 blog posts, 400 YouTube video links. If you'd like to get the slide deck and my outline, or if you look at my YouTube channel, which you'll find links to on my website, it happens to be Ken Boyd STL. And you see an Excel video that I use in a YouTube video, email me and I'll send it to you. You'll also see an extended 40-minute video replay of this presentation that I did live to a venture capital group on Accounting Accidentally on the homepage. I spend a lot of time doing custom created training for people. I do video work. I work as a speaker. So if you need any of those services, including live presentations, please let me know. And it's 44 after the hour, and I'd like to turn it back over to Teddy.